Again, I continue with the capital requirement by our IRB approach for credit risk in Basel II norms. So IRB approach for calculating risk, which is an attempt to recognize an individual bank's risk profile. The IRB approach uses bank's own internal estimate of creditworthiness. Now the IRB approach allow more customized and accurate risk profiles. However, the banks using IRB have opted this method because of the flexibility than the advanced IRB. So IRB approach has three issues. The first is the risk component, which is riskier estimate either developed internally or taken by supervisory estimates. Then the risk weight function, which take the risk component and translate them into risk weighted assets. And then the minimum requirement, which are standard that must be met before the bank is eligible to use an IRB approach. So the foundation approach in IRB is having heavy reliance on supervisory estimates. As you remember, supervisory estimates are provided to the banks. The only parameter estimated by the bank in the foundation IRB approach is the probability of default. The advanced approach, however, allows banks to estimate everything. Now, under the foundation IRB, bank estimate probability of default, and the IRB risk weights in turn depends on these default estimates. For example, when we consider corporate loans, the IRB approaches produces a risk weight of 14.4% for 3.03% probability of default. So the risk weight is actually dependent on the probability of default. This is something which we talked in the last class, where you can see that the risk weight is again linked to capital requirement, which is again linked to the probability of default. Now, the IRB method of calculating risk-weighted assets rely on four key quantitative inputs. The first is probability of default, loss given default, exposure default, and maturity and adjustment. Again, we talked about this in the last thing, and these are the equation on how they are related. The IRB approach allows the bank to use its own internal estimates of credit exposure to rate specific borrowers' default. The probability of default is generally to represent a long-term probability of default for all borrowers in similar risk classes. Now, LGD and EAD in the foundation IRB approach are set by supervisory rules. However, banks are allowed to use them in the advanced method. This requirement relates to documenting of high period generated and justifying their use. I'm talking about the advanced method. If they use that, they have to justify things. Now, documentation of probability of default calculation moves the decision making from purely quantitative to a more qualitative process. And we have the retail exposure, project finance exposure, and equity exposure. And the IRB approach bank need to set up credit risk control function, which is responsible for overseeing the selection of internal rating. The credit risk control function should test and monitor internal rating, prepare reports, and ensure the rating are applied in a consistent manner. And it should also document changes in the rating process. Now, interesting thing here which we move to is the expected and the unexpected loss. So in performing their own estimate for LGD and EAD, credit institution must estimate average or expected annual losses on historical data related to defaults. Expected loss is a component of credit business and should be covered in this regular course of business. Economic capital, regulatory capital is used for unexpected variation from expected loss, called the unexpected loss. This is something that we talked in the starting, that the whole idea of 8% is actually after the expected loss are taken care of. So this is for the unexpected loss, or the RAROC, if you remember, return on risk adjusted, and things that we do. So our focus always remain on the unexpected loss. Then we move to a little trickier part, which is IRB risk weight function. The risk weight function are used to assess risk and determine capital adequacy. The list of things that contains necessary condition for IRB credit risk weight functions are the ones that we are now going to look at. So conditions for the IRB credit risk function: expected loss are covered by provisions or revenues. Unexpected loss will be covered by bank capital. Unexpected loss will exceed capital at a small percentage of predetermined accepted probability. Risk weight should be portfolio invariant, that is calculation of loan is independent of the portfolio. Any correlation with other asset is not explicitly included in the risk estimation. So when everything is done, the capital requirement for credit risk under IRB approach is computed by something called an asymptotic single risk factor model, which is also known as ASRF. The ASRF is used to calculate the capital requirement, which is the condition expected loss minus expected loss into maturity adjustment. So the formula that you see down here, LGD into loss given default into probability of default, that formula becomes a little longer, and it becomes like loss given default into some other functions, which include conditional EL minus L, which is conditional expected loss, and and also things like downturn LGD into conditional probability of default, and risky asset correlation to which comes into play in the single systematic risk factor, and a little more things like that. So when this R comes into play, which is asset risk correlation, then this formula becomes a little longer. Otherwise we use the same formula that's shown on the screen. Now if we look at the credit risk mitigation techniques, and one of the intent of Basel II Accord is to increase supervisory regulation of credit risk mitigation technique. There are basically two types of approaches, the simple approach and the comprehensive approach. In the simple approach, the risk weighted of the collateral is used in lieu of the borrower risk weighted, whereas in comprehensive approach, collateral is adjusted periodically and that the value is deduced from the exposure. So that was it. Now in the next few videos we are going to look at market risk capital requirement. Thank you for watching this.